in, but that's fine. We have a few things to get through before we get to the discussion, so hopefully people will join us then. Thank you all for attending. We're going to be discussing carve-outs today, high risks, high return. So a different discussion for today's webinar. Before we get to that, a few housekeeping matters to run through. My name is Lena Dobrier. I'm the Director of Operations at Opus Connect. We are a lower middle and middle market M&A focused organization. We're membership based with chapters in LA, Chicago, and New York, where typically we'd be in each of those markets doing panels and roundtables once a month. But of course, everything is virtual now, including our Deal Connect events, which are our larger all-day conferences where we pair up capital providers and investment bankers and a couple other pairings for one-on-one meetings throughout the day. We do those in 15, 16 different markets now around the nation, also in Canada. So if you're interested in learning a little bit more about Opus Connect and how we can help, feel free to reach out to my colleague, Jacob Zeffrin. His contact information is below, and he'd be happy to answer any questions that you might have. During today's discussion, our panel will be taking live Q&A. They'll weave it into the discussion as appropriate and as they see fit. So please, as questions come to mind, go ahead and submit those at the bubble, in the bubble below. It's labeled Q&A. You can go ahead and type your questions there, and our moderator, Nate, will get to those, as many as he can. These events, of course, would not be possible without the support of our sponsors. So I definitely want to give them a shout out. I don't believe that Steve Finder is in the room today. He might be running a few minutes behind. So if I catch him later, I'll introduce him towards the end. But check him out, Focus Search Partners, Executive Search for private equity. They've been a great partner. You can reach out to Steve Finder for more information. And last but not least, CONTINUSERVE, who Nate will be moderating today. So I want to give him an acknowledgement here, but we'll wait until we introduce Nate and the panel for him to give you the full background. Before we get to the discussion, we do have a question that we'd like to ask and a couple others that we'll weave into the discussion later, but we'd like to know who's in the audience today. We're going to go ahead and launch that first poll question, and if you could submit your answer, we'd really appreciate it. This will be helpful for our panelists to understand who they're speaking to in the audience. I'm sure we'll see some investment bankers and capital providers as we are going to have those one-on-one meetings following this webinar, but go ahead and submit your response. We'll give it 20 seconds and we'll move on. Don't be shy. I can see which percentage of you are participating, so go ahead and submit your answer. If you're dialing in, I think that will not be possible, but we'll give it 10 seconds here and then we'll move on. Great. So 10% independent sponsors, 45% investment bankers, 21% capital providers on the equity side, and 20% service providers, a few others in the room. Thank you all for participating in that. Without further ado, I'd like to introduce today's moderator, Nate of CONTINUSERVE. Nate, I'm gonna bow out. Go ahead and take it away, sir.
Thanks so much, Lena. I really appreciate it. Hi, everyone. My name's Nate MEDOFF, and I'm excited to be the moderator today. It's a very interesting topic, and we have an incredibly experienced panel. So this is going to be, a lot of great information shared. A quick introduction about myself and my firm, CONTINUSERVE. I'm the founder and managing director of CONTINUSERVE. We're an advisory and outsourcing managed services firm that helps organizations obtain efficiencies and service improvement with their back office operations. We offer consulting, outsourcing solutions, which includes finance and accounting, business processing services, such as general accounting, FP&A, payables, credit collections, as well as IT managed services for corporate systems and infrastructure. And when we started the business 17 years ago, we began to develop a specialization in assisting private equity firms and corporations with divestitures or carve-out transactions. And specifically, we help buyers and sellers estimate back office costs and investments required to operate independently, as well as implement and support the ongoing management of that back office infrastructure. So that's my background, and I'd love to now go through our panel today and have each one of them introduce themselves. So let's start with Andrew Bushell from Cornerstone Capital.
Good morning. My name is Andrew Bushell. I'm with the firm Cornerstone Capital Holdings. Cornerstone was formed by myself and a partner 20 years ago. And my partner's name is John Alt. And we started as an independent sponsor. Although back then, I think we were called fundless sponsors. And quite frankly, I don't know if we knew what we were 20 years ago. We were just two guys that wanted to buy a small business. We were very fortunate. We hooked up with a capital provider that helped us buy 3 small companies. And they were all, when I say small, kind of in the 1 to 2 million of EBIT range. One of those companies we ended up getting very active in for about 6 years, which was not what we envisioned when we got started. And that company was in the aerospace industry, and got very involved and learned, how hard it is to be inside a small company. And eventually that business came back. Over that 10-year period, we bought out this investor. So we paid off his debt, we bought out his equity, and when the smoke cleared, we owned these 3 companies personally with management, and they had each grown to about 2-3 million of EBIT. Since 2010, since buying out those first original 3 companies, we've acquired 13 more companies. That includes 5 add-on acquisitions. And we're able to do all of those acquisitions with our own capital except for 1. And within those 13 companies, 8 of them were corporate divestitures. We had never really had much experience or were taken seriously with corporate divestitures until 2012. We completed our first one. We did that with a partner. We've since sold that company recently. But 6 of the 8 divestitures were in the aerospace and defense industry. We've sold 5 companies. Included in there were several of the add-on acquisitions. And so today we're basically a independent holding company. We have 6 companies, about 140 million of revenue, no outside shareholders, actually no outside debt other than some capital leases. And that is really our source of cash flow to buy more acquisitions, more smaller acquisitions. And really all we try to focus on today are smaller divestitures. It's really our focus today. Anyway, thank you.
Great. We're really looking forward to hear more about some of those war stories, Andrew. So next, let's go over to Ben Perkins from PHPARTNERS.
Good morning. This is Ben Perkins, and I'm happy to be on the line this morning. I'm a 25-year investment banker. Spent my entire career in healthcare and life sciences. The majority of that career was spent managing the group for Merrill Lynch in healthcare and life sciences, and then jumping over to Start and manage a strategy and investment banking team for Ernst & Young globally out of New York. Again, all of my career has been in healthcare and life sciences, so have worked with Pfizer on the spin out and carve out of Zoetis, which was a $15 billion transaction. Have worked with Medtronic on several carve-outs, have worked with Thermo on several carve-outs, and I'm happy to be here today. We're active with 2 major medical device companies right now, looking at carving out 2 of their businesses. So it's a timely conversation, and excited to share what we know about the industry.
Fantastic. So next, let's go to Diane Albano from Globalization Partners.
Thank you, Nate. First of all, I'm really excited to be here, so thank you everyone for attending. I work for Globalization Partners. We are a employer of record solution, which we'll get into a little bit what that means. My background is high tech and recently came to GP about a year ago, and really excited to talk to all of you about what this solution could help all of you with regard to carve-outs. Again, my background includes a lot of a lot of expansion globally. And so try to be a little bit of an expert, but probably not as much as the rest of the panel. But excited to be here and look forward to the conversation. So thank you.
Fantastic, Diane. Yeah, we definitely want to hear about some of the management and staffing risk and how your organization helps manage that. And last but definitely not least, Scott Porter from Brightwood Capital Advisors.
Hey everyone, thanks for having me. Scott Porter from Brightwood. Brightwood is a $5 billion, I think we got about $5 billion under management, primarily a credit fund doing deals with businesses, call it from 10 to $50 million of EBITDA. We do have pockets to invest all the way up and down the cap stack. So while the bread and butter is sort of Unitron senior stretch loans, we have the capacity to do second lien, mezz, and some equity co-invest in association with the loans. Brightwood's looked at plenty of carve-outs and has funded some. And prior to Brightwood, I was working in private equity for about 14 years, 9 of those years with Sengal Selassie, who's one of the founders of Brightwood. And in various groups, we've done carve-outs and have been through, all the things you got to do. So a lot of which we'll talk about, I'm sure, in terms of figuring out standalone costs, management culture, trying to set something up as an independent entity and things of that nature. So looking forward to the discussion.
Thanks, Scott. So before we dive right into it with questions for the panel and sharing some of their experience and finding and winning and managing and executing these carve-out transactions, I think it would be helpful for us to, for everyone participating, to gauge the participants' familiarity and understanding of carve-outs. So we actually have 2 quick multiple choice questions, poll questions that we'd love everyone to participate in if possible. So Lena, if you can prompt the first one, the first poll question: are you familiar with carve-out transactions? And we just have 4 options there. You're ranging your familiarity with carve-outs. This will be really helpful for us to understand if we have a range of experts or people who are just interested in learning a little bit more. So as we wait for those results to come in, my guess is we're going to have some experts in the audience there, and here they are. So it's a good range. We've got a good group, our largest group, of somewhat familiar, and then a few and very familiar, and a few respondents that are going to learn a whole lot today, which is great. And so let's just jump to the second poll question. Just based on that experience, from what you guys know, if you could just sort of give us your feeling what the biggest challenge is in executing a successful carve-out deal. Is it the due diligence risk, financing, the operational risk, or the management or staffing risk associated with managing value from the new entity? And on all of these areas, we're definitely going to spend some time with this panel, with the panelists, to understand their perceptions on these risks and how to manage them. Here we go. Operational risk, number 1, followed closely by due diligence and management risk and getting financing. So I would have to agree that, operating risk, the challenges of managing these carve-outs, especially with the opacity of some of their financials, they're being carved out from another entity, makes some of that very, very difficult. So we're going to get into some of those specifics. So as we move into the panel discussion now, we have some questions. I'm going to kind of go around each of the panelists, try and direct them questions that are akin to some of their experience. But as we go, if you guys have relevant questions to a particular topic, don't wait till the end. I'd love to view your questions as they come up, and if they're irrelevant to a topic, I'll work them in. And if we have time at the end, I'll select a few questions in the wrap up. So I think the first general topic, what we want to do is just do some general background questions about carve-outs, some of their core attributes. So Scott, it would be great if we could start with you. I think given the fact that we just saw on poll, we do have some people who are not that familiar with carve-outs. It'd be great if you could give us a synopsis or just describe what a carve-out is. What makes it different from a typical M&A transaction or acquisition?
That's a great question. You know, typically, so, you know, in your sort of garden variety deal, you know, there's an acquirer of a business. So maybe an entrepreneur runs a business, takes it from A to B, and for whatever reason wants to bring in help or wants to step out. And so you're buying a business that has been heretofore operating as an independent entity. And so you have all the usual acquisition issues, but you know, you're buying a standalone business that has ostensibly been operating independently successfully prior to your acquisition, to your involvement. In a carve-out, you know, maybe the easiest example is you're buying a division of a conglomerate. You know, you've got a larger business. A good example from my past private equity deal we did many years ago, we bought a company called Poco Graphite, which was the producer of the highest density and purity graphite in the world. But it was a company in Decatur, Texas, and it was a division of Unocal, the oil company. And it was sort of there were the usual issues as part of a larger entity where they felt they weren't getting the capital allocations. Maybe they disputed some of the expense allocations they were getting. And as a non-core asset, Unocal decided to divest. So you had to go buy we were going to go buy that. And if you were to just sort of strip that division out and leave it on its own, it's going to be missing certain things that it's getting from the corporate parent, everything from HR to technology, all those sort of things. And so you have to go through we had to go through the exercise of estimating what those costs would be. In some cases, coming to an agreement with Unocal on how to transition those services over to the company operating as an independent entity, and obviously figuring out what the management team of that's going to look like. You know, we were able to take the division president and the VP of finance from that division and make them the CEO and the CFO. And we installed an executive chairman to make sure everything ran okay. So that's I don't want to go too far because I know we'll get into it, but that's sort of the seminal difference of taking a division of a larger company versus buying an independent company on its own.
Yeah, great summary, Scott. So you mentioned there's a number of corporate services that just won't come over with the new entity. And so in some cases, you touched on a few different topics that we're going to talk more about. Transition services agreement to bridge the gap between the time it takes from when the deal closes to when you can have the time to build up some of those services internally or externally. So those are all, that's a great description. And you know, moving to the next panelist, Andrew, you've done a lot of these transactions. You've actually, you know, had some great success stories in taking these newly carved out entities and that in some cases they're forgotten assets or not really focused on within the corporate entity, and you're able to extract value. So when you think about that process or crafting a go-forward strategy for the new entity, can you talk to that a little bit? How do you go about doing that? What's the best way to think about crafting the go-forward strategy for the new company?
You know, with our situations, I wish I could say we had some grand investment thesis of some kind when these opportunities arise. Normally, they've been smaller divisions of very large companies, smaller meaning 10 to 50 million of sales, maybe inside of United Technologies, where we've done 3 separate divestitures. Usually they want to move very quickly. And so usually there's a problem. There's a customer concentration. There's just a stagnation. There's usually not, you know, superstar management in there, being a $15 million division of an $80 billion company. And usually there's a time sensitivity. So, you know, in our cases, I was going through our numbers. I think in every deal but 2, we had to replace the management, starting with the CEO on day one. And in 2 of the cases, we actually had to replace those CEOs that we hired after the deal closed, which was not what we had in mind when we acquired them, but you know, it happens. Some cases, the companies need to be moved. There are often a lot of gaps in management. So I'd say the biggest strategy we've had with each of these situations is standing them up as an independent company as quickly as possible, getting out of the hair of the parent company as quickly as possible, getting good data of where we're making money, where we're not making money. But the most important aspect of every one of these deals has been enhancing, replacing, upgrading, not only the CEO, but the CFO, the plant manager, the engineering manager, the sales manager. So we've been almost more of a recruiting firm than probably an equity or investment firm. I feel like we're full-time recruiters. And that is probably the most important aspect of these companies. We've been investing in sales and marketing and engineering. That's probably very important. That's been very important for a number of these companies. So it's really been about the people and the management and changing the strategy and the approach and the customer perception post-closing.
Yeah, no, great answer, Andrew. And actually, that's a really good segue to Diane in just touching upon this sort of management and staffing issues. I think this is a really good point, Diane, to talk a little bit about some of the other. We've mentioned a number of challenges, but what are some of the other special challenges, especially for global carve-outs with organizations with global operations across the world?
Sure, Nate. And basically, jumping on what you said, Andrew and Scott, I mean, from a people standpoint, as companies are looking at the carve-outs, where we specialize is on the international front, because some of these companies that could be carved out, or these divisions that could be carved out, there's small populations of employees, possibly spread over multiple countries. And so what does the acquiring company do as far as bringing those people on board? Well, setting up an entity or setting up a subsidiary is a lengthy process. It takes a lot of compliance. So one of the things that we found with our company, which specializes in international expansion for companies that want to go into any of these different countries, similarly with carve-outs, this is a way to bring these people, we call them professionals, onto the platform in an expeditious manner so that the compliancy can happen and the transaction can be completed. Because again, these little pockets of employees around the world could hold up the acquisition going through, it could hold up the transaction going through. So looking at an EOR type provider, which is someone that has the entity already set up, the subsidiary already set up in many countries like we are, really makes that transaction go smoothly so that there's not that risk of losing that possible deal based on timing, things of that nature. I'd welcome questions too from the chat room as we go along here.
Yeah, I mean, and I think that's a really, Diane, I mean, also, I think it's worth mentioning, a lot of these carve-outs occur, they're not always, subsidiaries or business units within a conglomerate. Sometimes they're just a product line that gets sold or a set of assets. And in that case, you really are sometimes stripping off a couple of engineers that may be sitting in China, a few, maybe a portion of a service desk sitting in South America. And you don't have the scale with the new entity to, have those entities. And so providing that solution can really help cut through a lot of that bureaucracy and take away some of the risk of continuing the operations.
And especially today in COVID times where everything is taking longer. So even if you thought that you wanted to set up an entity in a country, it's going to take a long time. And oftentimes it requires wet signatures, and you've actually got to be there. You've got to set up bank accounts and compliance and rules and regulations. It's not for the meek, that's for sure.
That's right.
And some countries can take a year to a year and a half to set up.
That's right. So, you know, another real complex aspect of this sort of commingling of operations and management teams and sort of the, you know, potential, you know, as Andrew was talking about, rebranding of the carve-out. These are all these challenging aspects. So when you're looking at deals like the type like this, Ben, and you know, you've clearly identified these risks. You know, what are the things that you also look for on the return side that tells you like, hey, here's an asset that's really worthy of taking this risk, this execution risk that we've been referring to?
Sure, and I think that's a good question. As we look at the carve-out world, I mean, we cannot really underappreciate how much work and energy and distraction goes into these carve-outs. It's just a brutal experience for the parent company, and really requires you to question, okay, what is the parent company's motivation? And there's generally three motivations that parent company will have. One is they've taken a tack to focus on the core, and there's a core strategy and a core product offering that they want to spend time and energy on. The second would be that it's really an underperforming business unit and maybe is not part of that core moving forward. And then third, and probably the area where we spend the least amount of time, and I would argue most people should spend the least amount of time, is kind of those desperation carve-outs where the company is struggling, needs cash, and is just trying to unload assets as quickly as possible. But if you can get comfortable with that high level of why the company is pursuing the exit or the carve-out, the interesting questions you need to ask yourself then are, what is the difference between the parent company's margin profile and the subsidiary margin profile? Because that plus the equity return on capital investment can be good motivators for why these companies are divesting of these assets. To dig in a little bit there, when you think about a drug, and I'll just speak to my world because it's easiest for me to speak to. When you think about a pharma company that has very high margin drug business, they look at it and say, well, maybe I should carve out my manufacturing infrastructure because that's lower margin business. That's something that investors are not going to give me credit for. So why hold on to that as my investors are looking for a high return on their capital? That doesn't mean that those manufacturing facilities are bad assets. It's just a completely different investment profile. So that's how you should be looking at this, as what is the motivation of the parent company? Does the business provide a return on capital that is meaningful to your investors? And then you can dig into, okay, how do we make this happen? What's the best way to do it? And honestly, one of the best ways to get good, meaningful insight on that is talking to the group president or the manager of that business, because he'll tell you or she'll tell you pretty quickly, hey, I just can't get capital for investment in this business because it doesn't marry with the parent company. It's a difference in strategies, those kinds of things.
Right, right. And that's you know, that's what we tend to see is sometimes there's tremendous value within the asset, and it's just not been a focus area for the current owner, and it's something that oftentimes they're aware that value's available. So one thing though that I also have always found interesting is that, you know, we've talked about the risks of these transactions. They're tough to execute. We've got a bunch of questions, or a couple of questions about on the execution side, which we'll definitely get to a little bit later. But it's a pretty small group of buyers out there that really try and focus on these carve-outs. And what I find interesting is these deals, or the really high upside deals, and there have been some tremendous wins in the marketplace. Oftentimes they're really hard to find as a buyer. So Andrew, I'd love to hear a little bit more about how you guys approach finding these carve-out opportunities as a buyer, especially in the kind of smaller, you know, and mid-sized organizations that you guys have acquired. Do you have to build reputation in an industry or a specific sector to get visibility, relationships with these types of conglomerates that are always in the business of buying and selling their subsidiaries. Talk a little bit about that process and finding those deals and then moving forward on them as well.
Yeah, so of the 8 divestitures that we completed, 7 of them did not have a banker, which was surprising to us because in our first 10 years in business, it was very hard to find opportunities without some sort of intermediary. We've been very fortunate because we got very active inside a company during our first 10 years in business, and in particular this aerospace company we were very active in. Got to know a lot of managers, a lot of customers, a lot of angry customers who, eventually weren't as angry after a while, but got to know a lot of people in the aerospace world. And I think that was very helpful in finding our first divestiture, where it was actually a manager who I had interviewed 4 years earlier for a company. And he was in Southern California, and we kept in touch. And he ran a small division of a British aerospace conglomerate. And I got a call about 4 years later, and we were able to put together a deal, to buy that division from the parent company. Now this, I would classify more as it was a quasi product line, business. It had about 60, 70 people, but it did not have, its own engineering, its own sales. It was really it needed to be moved. So there's a lot of work involved with this entity. And I think one reason they went with us was we had prior experience in moving an aerospace company. They liked our prior aerospace experience. And I think it was very helpful in convincing them to go with us for that first divestiture, which was it was a critical deal for us because it kind of got us in business. I don't think anyone wants to be your first. A lot of times with these smaller divestitures, they're more interested in whether it's going to close. I don't want to look bad with my boss. I don't want problems. And so looking back, I think we're very fortunate this large company went with us that first deal, and that led to, shortly thereafter, our first divestiture with United Technologies. And it was about a $12 million unit, and they liked that we had just completed this prior division. So, and then it kind of fed on itself. It was like it's like the more you win with these deals, because it seems to us, particularly with the smaller companies, the large company just wanted someone they were confident would close. Like Ben mentioned, we have done a couple situations where it was an unloading of an asset, where the parent company wanted out at all costs and quickly. We happen to like those situations for the right price. We've had some luck with those, but they're not easy, very hard. One of the cases I had to get in there for about 6 months, which is that's a real train wreck if I'm in there. And so, we'll do whatever it takes to close and close quickly. But more to the question, almost all but 2 of our divestitures have been in the aerospace and defense worlds. I think given, that we have some experience in that industry, it has helped to win additional deals. The 2 deals we did that were not in the aerospace and defense world, we actually got to know them because the parent company had an aerospace unit, and we had sold a facility to one of the companies. So even the non-aerospace companies had a connection to the aerospace world. We do look for non-aerospace divisions, but our story doesn't resonate as well. So it is a focus area for us.
That's interesting that these deals, and this seems like a distinct difference. Then it's the seller, because there's this probability of an ongoing relationship post deal close through a transition services agreement. They're often selecting the buyer based on other factors than price. It sounds like speed, the ability to execute.
I think another factor with us is a lot of these companies, like United Technologies, they're selling a division, and they want to have some confidence that the buyers are not going to make them look bad with the customers, because they're doing business in other divisions with those same customers, a Boeing or Goodrich or whoever it might be, a Sikorsky, Lockheed. So I think as we've had success with these aerospace companies and have not had any bad experiences yet where we've you know, we've done what we said we're going to do. I think the buyers want to make sure that it's in hands that are not going to make them look bad with the customers, because often they have the same customers in other units,
Yeah.
you know, of the conglomerate. So it's been helpful for us in winning these deals.
Yeah, and I assume they also are interested in making sure that you know the buyer can actually operate independently in a quick time frame and has the ability and has done that before in the past, so that they're not sort of overly dependent for a long period of time on a transition services type of arrangement.
Just to build on that for a second, I mean, I think you can't overstate, particularly in situations like Andrew mentioned, where there's going to be an ongoing relationship, be it you know, shared clients, or in some cases, I mean, I did a deal where the acquisition, the fundamental, what's the same deal I talked about before, Poco Graphite. In order, their secret sauce to make their graphite was that they were using the petroleum coke, which was a byproduct of the refining process at Unocal, and that it was something that nobody else could duplicate. But we needed to make sure we were going to get that petroleum coke and get it to the specifications we had historically gotten it. And so getting that transition services agreement just right and making sure that the independent entity was going to have the right access to the right material from the former parent was pivotal. It was the core of the whole value proposition of the deal. So that stuff you can't overstate the importance of that stuff.
Yeah, very, very interesting point. We've also got I think the next question it pairs well with one of the attendee questions. Stephen has posted a question. He agrees with sort of some of the risks we've stated, but he's emphasizing the management team is a really critical aspect, you know, from an execution standpoint of managing this risk. And that kind of matches with the next question, because you can't, these days, every business is being impacted by COVID. Diane, I'd be curious to hear your point on this question with regard to managing, you know, assessing the risk from a staffing and a management perspective, which Stephen in his questions has highlighted is just an absolute critical factor for success. You know, especially now with COVID, how, you know, does COVID add to the risk return profile of these carve-outs when you may not have as much face-to-face interaction with the people that are coming over from the parent entity?
It's a great question. I mean, I think, let's face it, COVID has changed the world and the way that we work. And I think that has provided what we've seen, even in our company, is a lot of different ways that companies are doing business. So when we think about a carve-out, the risk of acquiring a division in another country with or without a good management team, but the ability to now hire that management team and know that they could be managed remotely, because we've all been doing that now for 8 months. We haven't physically seen each other. We're looking at each other in 2D. And so I think when companies are either acquiring or thinking of divesting, they can really look at being able to do that in a way that maybe they wouldn't have thought otherwise. So you could have a country where you've got a small pocket of people, it could be the UK, let's say, but there's no manager there. You could really hire anywhere in the world, get the best talent, and manage that division remotely, because that's the way that we're doing business. And what we're seeing with our customers, and we are getting hundreds of net new customers a quarter, that's exactly what they're doing, whether it's a carve-out or international expansion. So I think that same theme goes right across to carve-out situation. It shouldn't feel as daunting and scary. Now, what would be scary is trying to, like I said before, set up an entity or set up a subsidiary, because that is a tough process. So being able to find a way to do that seamlessly, putting these new employees on board in a matter of hours or days, really does take away that risk. And if it's incorporated into the TSA, then it's a great way to be able to mitigate any of the risk and assure for a smooth transition. So that's the way I look at it, Nate.
Yeah, very good. So we've talked a little bit about the talent management risks. We've talked about how the difficulty of sort of uncovering value. Let's move into actual valuation of the new company itself, of the financial structure. So I'm going to go back to you, Scott. Tell us, it sounds like you've had experience with a lot of different sort of financing structures. So tell us a little bit about financing for carve-outs. How's that different from a typical transaction?
Well, I think, you know, I mean, Andrew, as you can tell, you know, you have people like Andrew who are specialists in this. And
Yep.
I think a lot of folks certainly in the debt community and to a large degree in the equity community feel that carve-outs are really the domain of experts. You know, similar to healthcare, actually, in a lot of ways, right? You know, I don't touch anything in healthcare that's not, you know, sort of made for dumb people, because if it gets too complicated, it's just, you know, it's not my specialty, and I'm probably going to miss something. And I think the same can be said for carve-outs. So it can be harder to get debt financing for carve-outs. I think a lot of credit funds, Brightwood included, step more lightly when it is a carve-out. And there's a couple reasons. I mean, I noticed when on the poll question at the beginning with what's the biggest risk with regard to a carve-out, I was reflecting about how all of those risks affect each other. You know, it's harder to get debt financing for a deal, a carve-out deal, because of the enhanced due diligence risk, because of the enhanced management risk. All of that sort of stuff interacts. A lot of it on the equity side, when I've been in positions where I was, you know, purchasing a carve-out entity, a lot of it gets to sort of standalone costs, right? And it's not only below the gross profit line. First of all, you got to figure out what's the real profitability of these products. You know, in the case of the graphite business, there were the highest density products had amazing gross margins of like 80% gross margins on this one product, which is sort of the secret sauce of the business. But that was dependent on getting, as I mentioned before, that raw material to these exact specifications. If we hadn't figured that out and we hadn't made that arrangement with Unical, the business might have faltered. And then once you get below the gross profit line, there's all of the other sort of SG&A expenses that you're probably going to have to, first of all, ease into via a transition services agreement, but also estimate what are those fixed and variable costs going forward and how will they function in the company. So in order to get to a real valuation, you have to have a really good handle on those costs. And that's where, in my opinion, that's where a lot of that risk lies. Not to mention management, at which whoever put that question in, you know, it's so pivotal. There's always going to be disruption when you're carving out a business. There's always going to be folks raising their hands thinking they should run it, et cetera, et cetera, et cetera. If you're bringing in new people, there can be friction there. As Andy said, you can bring in a CEO that you think is great, and 6 months later you realize it's the wrong person. All of those kinds of risks are enhanced with a carve out as opposed to a standalone entity. So I think the big thing is to get a high degree of confidence, whether it be through through experienced hands on your team, and through diligence and through talking to management, so you can get a decent picture of what this business looks like a year down the line post acquisition. Because without that, you're nowhere in terms of valuation. You know, and a lot of people will apply some sort of conservatism to whatever multiple they use, regardless of what EBITDA they get to, you know, because of all those intersecting risks. Yeah.
And that's actually a great segue to the next question. And Ben, we talked briefly about this the other day. I'd love to, you know, as Scott was kind of going through and talking about risks and how they impact valuation. I'm sure in a lot of these deals, there's often a pretty significant gap on perceived valuation between the seller and the buyer in a carve-out scenario. What are some of the ways that you can bridge that gap in a carve-out type of situation that you wouldn't see as leverage as often, or you wouldn't be capable at all of leveraging in a typical M&A transaction?
Yeah, so generally, I mean, let's talk about kind of two distinct types of sales. So if you've got a private equity owned business that's looking for an exit, they're generally looking for what's the largest number you can put on the barrelhead in the next 3 months to help me transact. And they're not interested in earnouts. They're not interested in the long-term value, usually, just given their fund dynamics. So that tends to be, let's get the deal done. Let's transact with as much capital as possible day one. When you're talking about carve-outs, it really goes back to what is the motivation of the seller. And as we discussed earlier, if you've got a business with a different margin profile or a different capital allocation requirement, it can create friction within the company. And that's why they want to dislocate that business and put it in the hands of a different owner that can maximize that opportunity. When that happens, I mean, so I can talk at high levels about the kind of 2 deals we're working on right now. One of them is a high risk, high reward business that's stuck within a low margin, low growth business. And so that parent company, if they were to invest $100 million in this high risk business, their investors would likely skewer them. But if they're able to create a partnership with an investor through a carve-out where they can retain some of the equity in that business, unlock the value through creating a new management team, bringing in new capital, that creates the opportunity for them to monetize some of the business today, but keep a foot in the business for that ultimate success. And they don't have the risk of the downside of investing $100 million in capital. Now, the alternative is, and Andrew, I think we can talk a little bit about how, and he's been successful and he's been very successful. When you talk about some of these smaller businesses, it's all about relationships. So his ability to leverage that UTC relationship and build trust with them so that they know that he's going to get the deal done, he's going to execute so that it doesn't embarrass them in the marketplace, and UTC is able to move on. That's an example of another kind of deal that we're working on right now, where understanding the motivation of the buyer, what's become clear through the process is they believe there's a liability as part of this business from a historical litigation standpoint. All they really want to do is carve out that liability from the parent company. They acquired this entity 7 or 8 years ago. It has not gone the way they thought it was going to go. They really want to move on and move forward cleanly. So while they approached us originally and said, hey, we want to get rid of this business for $20 to $30 million, the way this deal has morphed now is, hey, we'll take the business off your hands. We'll give you some equity in our business, but you need to finance this sale. So the seller is going to finance an instrument of $12 to $15 million to facilitate that deal happening. And what they're trying to achieve basically is moving on, getting that liability off their balance sheet and moving forward. So there are a number of different ways to structure a transaction if you truly understand the motivation of the seller.
Got it. No, that's great. And I think you also, and to build on that answer and Scott's point, you know, kind of one of the difficult aspects of this valuation and negotiation process is estimating the costs associated with operating as a standalone entity, and you know, kind of creating that go forward financial model. Andrew, how have you done that in the past, where there typically can be, you know, a lot of opacity and kind of understanding what those go forward, you know, operating independently costs will actually be?
So, you know, the biggest items have typically been the benefits, the health insurance, the property casualty insurance. So a lot of times the sellers will say, you buyer, you need to maintain the benefits of our employees for at least a year. We don't want you to buy this and then slash the benefits. And for many reasons, and as a buyer, we wouldn't want to do that either. So often they have, you know, a health insurance plan that's typically very rich. They want us as a small company to maintain those rich benefits. When we did the first divestiture, we never thought as a small business we could maintain those benefits at a similar cost. Surprisingly, we've been able to maintain the costs and sometimes cut the costs of maintaining similar benefits. And we've done that by using a lot of PEOs. And so we use PEOs at a lot of companies. It's a great way to get big company benefits at a small business. The other big item is often the back office, the accounting, the insurance, The non-health insurance, we have to get on our own. D&O insurance, EPLI insurance. So as we've done more of these, you get a little better. We've developed a good partnership with our PEO and an insurance brokerage, which I didn't appreciate as much until we started to do these carve-outs to get good estimates of what these insurance costs are going to be post-closing. And then there's the CFO types, the accounting department. A lot of times the IT transition is the hardest part. In every deal but one, we've had to convert an MRP system. Usually, you've got the an Oracle or an SAP kind of system, which are not appropriate for a $20, $30 million business. What we have done to get better at this is, and it's also because we're in mostly aerospace companies, we've gone to the same MRP system in every single conversion but one. So we've got a little smarter with each situation as to what it's going to cost to convert, what are the licenses cost, then the implementation costs can get out of control if you're not careful. And sometimes we haven't been as careful as we need to be. So we've gotten better at estimating those costs post-closing. Those are usually the biggest gaps. In one deal, there was no engineering staff, so we factored in some engineers. In one deal, we had to move into a new facility within 6 months, so we had to factor in a build out. We underestimated that build out, so that was a learning experience. But there's no simple way except trying to be conservative, which we've gotten better at over time.
Yeah.
Just to build on that, the other thing you just said it is time. You're estimating these costs, but it's also about being realistic about what the timing is of those things. I mean, every CRM, anytime I see a business like, well, we're just converting our CRM, it'll be done next quarter. No, it won't.
Yeah.
No, it won't. So and that obviously the time it takes to make some of the transitions that Andrew's talking about affects the business's ability to operate, which affects the overall modeling and valuation.
Yeah, no, that's a great segue actually, because we have a couple of questions that have come in. I want to make sure we do spend some time on the execution risk of these deals, and it's been asked by Matt online here, and we had a question as well for you, Ben. And that's, kind of the new infrastructure, IT infrastructure, IT systems specifically. How do you think about that for the new carve-out? A lot of times, for example, just going back to the example Andrew gave, which is maybe you're buying a smaller business unit from a multi-billion-dollar conglomerate. The standalone entity is a $50 million company. You probably don't need SAP and the tier one infrastructure and systems that they did. How do you think about that? The sort of lift and shift process, not having to stay on that TSA for a couple of years, those challenges. What's your checklist in thinking about that process?
Yeah, and I forget whether it was Andrew or Scott that were referencing the fact that most of these major companies are using systems that are far too expensive for a smaller entity. So there's usually a 1 year to 2 year transition period where we're using or leveraging the infrastructure of the parent company until we can get our feet underneath us from a management perspective and understanding truly some of the infrastructure needs from an IT angle. So those TSAs can be set up, and it's a negotiation. Obviously, the parent company wants it to be a month. The acquirer wants it to be a year or more to provide the comfort that you can transition in a smooth and orderly process. And I feel like, Nate, you would know this. There are good groups like yourself out there that get involved more so in that piece of the equation to help shepherd a client through that process. Really, the big thing for me when I think about the new infrastructure of the entity is you've just gone through a significant corporate change, and you've created a lot of uncertainty for the employee base, and that generally causes difficulties with retention. And so that's one of the areas where we spend a lot of time thinking through is, okay, how are we motivating this new group whether it's equity, whether it's compensation, whether it's assurances that, you know, nothing's changing in this smaller entity, making sure that it's going to be functional day one. But that also, an interesting point that we haven't brought up yet is, most of the time, the parent company will say, hey, we'll give you access to the general manager, the controller of that group, and very few other people, because they don't want to create personnel issues. And so from a diligence perspective, and we've glossed over it a little bit, it's difficult getting to true answers as quickly as you'd like, because you just don't get access to those employees, because the parent company is trying to maintain some sense of normalcy in that organization.
Yeah. Yeah, I mean, whether it's IT infrastructure or the employee of record services, as we've talked about, insurance, you know, this build versus buy choice is something that comes up for the new company, the new owner. And there's a lot of very mature service providers out there. Obviously, our firm specializes in these, that we can help sort of right size a system or an IT infrastructure for the new entity in a quicker time frame. And Diane, I think we're pretty close to the end here, and I wanted to make sure we do talk a little bit in detail about this transition services agreement. We've been referring to it, oftentimes when you go from a discussion about buying and acquiring an asset with the seller themselves, and then they become your service provider, right, through the TSA. That can change incentives a little bit. So maybe you could talk a little bit about how buyers can mitigate some of those risks within the transition services agreement to ensure that there's no degradation of service or no increase in costs or any other surprises for that matter.
Well, it also stems from what you said, Andrew, with PEO services, because people typically are the biggest asset. So making sure that all these negotiations are done and thought about in a planful way. I think that's really important. When you look at international, global folks, an EOR is basically equivalent to a PEO here in the States. So it's a very similar concept. Again, you have to think about all these different countries. Again, I'm taking the global side of things. The different countries, the different regulations, the compliance, just dealing with governments, all of those types of things. So again, when you're looking at that global piece, relying on global firms that understand that, I think is a very important attribute. And you have to look at it from a head count, all the different things that are compiled and part of that carve-out when it comes to that transition document, and making sure that that's done in a planful way. And so, again, I've talked about our services, something that certainly can help from a people perspective, which was noted as one of the most important attributes in a carve-out. I think it's really important to look at how you're going to take on, as this acquiring company, these additional employees all over the world. And it can be done pretty seamlessly, or it can be done with a big headache. So that's sort of the way, we look at helping companies that are in the midst of a carve-out. Thanks, Nate.
Thanks. Thank you. I think we're out of time. The last just comment I would make is, we talked about COVID. I predict, and I think everybody on this panel would agree, the market will see a lot more of these carve-out opportunities in the near and medium term, as a lot of companies are going to be shedding non-core assets. And we've just scratched the surface with some of the specific experience and details associated with these transactions. But really, thank you to the panelists. You guys have had really fantastic insight and experience, and I'm really glad that I was able to take part in this discussion.
Thank you, Nate.
Yeah, thank you, Nate. Thank you for moderating. Wonderful job. And panelists, thank you for your contributions. I think this was a very interesting discussion, and definitely differs from the discussions we've been having. So we'll be posting it on our YouTube in a day or two. Look out for that. We do have kind of a part 2 to Carve-Outs webinar coming up on the 8th. Finding the diamond in the rough. So we'll be sending you more information on that. If you are participating in our Deal Connect event, you'll want to log out of this, this link now and log into the separate link that my colleague Terrence Winters previously circulated. Again, I want to thank you all panelists and Nate for leading the way, and to our attendees and our sponsors, thank you for joining, and we'll see you all soon.
Thank you
Thank
so
you all.
much.
Thank you.
Thank you.
Bye.
Nice meeting everyone.
Nice
Likewise.
meeting you.
Thank you.